So before we get into the ETM trading model, we need to understand what a shelf is. The shelf would be the pillar to our strategy, basically that holds everything. So here you have a structure break. What does this structure break to the upside mean? That means bull order's been injected. Buy order's been injected to push price over the structure. That means this whole area, somewhere along this area, order's been injected. And when price does return to this area, price could reverse anywhere. It could reverse here, here, here. We don't know for certain, but what we do know is buy order's been injected here. So let's break this entry model down. So here you have your break of structure. What could have caused this break of structure? It would have been buy orders because this expansion is to the bull side, and these orders would be resting in your shelf, which would be between your high and your low prior to the break. So now that we know there's buy orders here that push price higher, we know there might be leftover orders. So when price does come back, it more than likely will reject. So when price does come back and reject, it forms your first interaction. Your first interaction is your first test. It shows that, okay, the orders are resting in that area. There's still leftover orders there. And at the same time, a lot of retail traders would take a buy somewhere at a breaker, or let's say they have a order block there or support and resistance level or whatever, right? So let's say some retail traders got smart and they took this trade. So now the market is incentivized to take their stop losses out before continuing to the upside. And that takeout level right there, the liquidity sweep, is our purge. And this makes up our ETM trading model. So let's get into it. The most important thing that you're looking for is your basis. So you're looking at your shelves, right? So let's say price consolidates, expands, distributes, what do you notice here? What you notice here is these bases, these areas of price breaking out of the shelf. Once price breaks out of the shelf, you got to understand that there is volume here. So let's say we're taking this shelf to an example. This would be a shelf where a lot of sell orders were injected. So now that we know that there's sell orders injected here, and pull back to this area, we understand that there's orders laying here. Sell orders could have been injected here, 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 or even at the extreme, which would be your extreme order block. We don't know exactly where the orders were injected, but what we do know for sure is something happened in this accumulation that forced price for a push down. A lot of orders came in that forced price to change direction and distribute, and we know a lot of decisions are made in these bases, which is also our shelves. So now that we know the decision was made here, the orders are resting here. So this is what we take advantage of when it comes to the ETM trading model. We take advantage of the first interaction, which would be testing this area, confirming that there is orders laying down. And we need to see a reaction. We need to see that price met these orders and went for a small drop. This drop is a confirmation that this area does have orders. And what happens? Anybody that takes a sell right here, all the retail traders, they take a sell here, or they see this rejection and maybe they take a sell right here. Their stop losses would be right here. So the retail trader stops would be right here. So what we'll be looking for is to now that we got our confirmation and we know the trader's been trapped here, this is where their stop losses are laying. We're waiting for that second leg to take them out. And this is our entry. Once price takes them out and drops back into the previous range, this is when you know this is our ETM entry. So let's look at the framework. First thing you want to do is you want to locate your shelf. Once you locate your shelf, price has been trapped within this range for two swings. So your swing high here and your swing low have been trapped within this range. And you had this expansion. This expansion proves that there have been buy orders injected within this shelf, within this base. So now that you know that, price came down and reacted from this level, reacted from our shelf, proving that buy orders were injected here and the buying power was shown right here in this interaction right here. So this rally proved that there's been buy orders here. So what you're waiting for this level to be taken out. The liquidity being taken out right here, price coming down and closing bullish. And once price goes bullish, you can take your entry. And again, this entry model works perfectly when the structure holds a macro support and resistance structure. So again, if the previous macro structure was supply and demand, then this would nullify the trade. If price was reaching deep for extremes, this would nullify the trade. So you want to focus on a support and resistance structure profile. Price will take this level and expand. Now, let's say price does come back to this level again. Price came to this level again and showing another reaction. So what you can do again is go for your second entry, which will be taking this level out and continuing to the bull side. What does this pullback mean? This means that the orders that they took right here to push price up was not enough and they need to come back and take more orders from this base. This base is everything. This is where the money was injected. Again, you can say the money was injected in this candle, in this fair value gap or whatever, but we don't know any of that for sure. But what we do know is orders are injected in our shelf, in our base. Price will take this level before expanding. Of your ETM trading model. So here you have your range. You have your high and you have your low. So this would be your shelf, which is also your base. This is the high and the low, and price consolidated and expanded. So what do we know now? We know that there were buy orders injected here that forced price to break out of this structure, which gave us this big move. And where is the first interaction? The first interaction was right here. This is where price came and tested this area. So now what you want to do is you'd want to mark this area. You'd want to mark this area knowing that price would want to take this level out. Price comes back and barely but does take out this low. As you can see, even though it took about less than 1 point, price did come back and take this low out. And your entry can always be a candle close, or it could be a continuation by breaking out of this base. Price will tap this level a few times before finding a lower entry to break out of this range, or you can take a continuation once price breaks this structure. So the most optimal way to trade this strategy is to trade it in line with the trend. So let's say your macro direction and your micro is bearish, and you're seeing proof of support and resistance structure. So if you're seeing proof of support and resistance structure, that means price is holding this profile. So again, if it was a supply and demand structure, this entry would not work because price is retracing too deep. So you would want to see proof that the support and resistance structure profile is holding and you're in line with the trend. So when price does go for your initial interaction and retraces and gives you a fair move to the downside, it can't be a too small of a move, and it better not be too strong of a move. And then when it comes back and take these stops and retraces, that'll be an entry. Now, the big do not for this strategy would be trading counter trend. What would be your counter trend in this scenario? It would be if price reversed and broke structure. So now that price broke structure, you're not looking for, let's say, a move to the downside. So let's say you're not looking for a move right here. You're not looking for price to take this high based on this base. Why? Because the structure changed. You've seen a change of character right here. Price broke structure and is starting a new consolidation, which would be your new base. So instead, what you would be looking for is you would be looking for a move to the downside and look for the closest shelf for your initial interaction and for price to take that level out to continue, instead of looking for a counter trend somewhere here. That's why this trade right here will fail. Now, you did take out the initial interaction, but it's counter trend, and this would be a failed purge. So this variation is the lowest quality when it comes to your ETM trading setup. Again, as far as your structure goes, the support and resistance structure have been respected. There has not been any visits to your extreme. So as far as your overview, everything looks fine. Now, the only thing that makes it a weaker entry model is that there was no contact. There was no contact with your base. So here you have your high, here you have your low, and this is your base. Price did not make contact. So it did not conduct the first interaction, but price got close to it. So now that you know the price got close to it, you would mark up that level, and you would anticipate this level to be taken and a contact being made with your base. So again, the first interaction would be your entry. And again, this is a lower quality setup as far as your ETM trading model goes. It's not the worst, but again, it's not ideal, right? Hope you guys enjoyed this lesson. Make sure you like, share, and subscribe, but make sure you click that notification button because we have a huge lesson coming up next week. Stay tuned.